Good morning. We're very glad to present our preliminary research project. We are Ana Daniella, Mauro, María Fernanda, and our project is entitled Dynamic Estimation of Corporate Bond Yields based on the Credit Risk Merton Model, Practical Implications for Mexican Public Firms. Before getting into the main details, we would like to specify that bond yields movement are primarily driven by two elements: external economic factors such as interest rates and internal or intrinsic factors of each company. These internal factors naturally include the credit quality of the firm. And as we know, these factors are unstable. And that's why we're very interested in developing a project that can read this yield movement path. The idea initially started since we wanted to merge our two main interest fields, credit risk and the bond market.
The general idea of this project is that currently there's a static methodology to determine the price of corporate bonds in Mexico, which implies an asymmetric valuation that generates a gap between what the market is paying and the true valuation. As you can observe in the table from the left, we wanted to show as an example the frequency of the credit rating update of a specific debt instrument of América Móvil, which is AMX 10U. Also, we use Standard & Poor's Global Ratings as a credit rating agency for this example. With this, we can clearly observe that there is a static methodology because the ratings are updated in an annual basis, sometimes even every 2 years. What we're trying to do is a dynamic estimation in order to have an updated pricing of corporate bonds and avoid asymmetry due to timing issues. Also, as in the graph on the right, we want to compare the yield spreads observed in the market that are represented by the purple lines versus the yield spreads that we'll calculate with our dynamic model, which is the white line. This is only an example, but we want to do this in our project so we can acknowledge the difference and take advantage of investment and financing opportunities.
Here's the agenda we're going to follow. We will start by showing you our background, looking forward to see different kinds of papers that are related to our topic. Then we'll proceed with our research questions leading to the list research problem, followed by the general and specific objectives. After that, we will explain our literature review in order to present what has been made about our topic in the past regarding to our research objectives. To conclude, we will show you our epistemological position, study type, research method, and techniques, as well as our bibliography and references.
A background is always helpful to show the previously made research that is similar to our topic. In this slide, we place the 6 papers that we consider the most representative out of the whole papers that we found related to our topic. We start with papers from 1999 to the most recent in 2019.
We will start with the authors Liu, Sajet, and Smith, who in 1999 proved that it is more likely for a change in a bond price to occur due to an adjustment on the credit quality started by the credit agency than by a specific change in an issuer's financial health. So, if the financial health of the company improves, it will not be directly reflected on its bond price until the agency updates its rates. This is an example of the asymmetric valuation that our dynamic estimation project will focus to avoid. Now, we proceed with the work of Gutter and Waterberg, authors that, in 2007, investigate about the adjustment of credit ratings in near-to-default issuers that were rated by both Moody's and Standard & Poor's, presenting evidence about a more punctual risk adjustment made by Moody's than SAP, telling us how Moody's detects risk changes in a quicker way. This gives the chance for the issuers only rated by Standard & Poor's to increase their risk without having an immediate downgrade of its rating, giving the prospect of generating gaps between its actual value and a possible dynamic one. This is another example of the asymmetric valuation we have discussed in our general idea.
In 2009, Downing, Underwood, and Zink made an analysis of the informational efficiency of stocks and bond markets. They state that in spite of the improvements in the transparency on the corporate bond market, it turned to be less informational efficient than the stock market. They analyzed this with a cross-serial correlation between the daily returns of stocks and bonds, and they confirmed that the market of corporate bonds turned to be relatively opaque compared to a market of corporate equity. Therefore, is less efficient. In this project, the aim is to get a deeper analysis of the corporate bond market and use a dynamic estimation model to have efficient information available. Now, in 2010, Livingston and Lee made a research about split bond trading and information opacity. As we know, the firms that issue public bonds receive ratings from different agencies. So they found that the rating analysts and financial experts from different agencies cannot agree with each other on their assessment of a credit rating for the same firm. This is also known as split bond rating, which causes information opacity. The main objective was to analyze the impact of information opacity on bond yields, and they found an asymmetry due to the fact that the split traded bonds yield about 7 basis points higher than the non-split traded bonds for similar credit risk. In our project, we want to avoid this issue by having a dynamic estimation and not depend on the annual credit ratings from different agencies.
Barnard on 2017 shows that the default probabilities of different rating categories are time-dependent and not isolated from each other. This article develops a bond valuation of different credit quality bonds. However, his work is different from us because he focuses on the risk migration of bonds over time, and its estimations are made under an annual frequency, and we aim to achieve a dynamic valuation. Later, in 2019, Brian Barnard comes again, but now he delineates the cost of default by calculating possible future bond prices at a certain point in time and comparing the output price probability distributions with conventional bond valuation models. This paper is very similar to what we intend to do. However, he still does it in a static way. As we said, he calculates the price at a certain point in time, and we aim to do it in a simultaneous way in a daily basis or dynamic way.
In order to establish our main problem, we will first answer the research questions. As in any other project, we start with the what. In this case, there is no evidence about dynamic corporate bond valuation methodology. When does this happen? Nowadays. And where? We are focusing our study on the Mexican financial markets. Now, who is involved? The companies and investors. And what does it cause? It causes information asymmetry that leads to the missing of investment and financing opportunities. Finally, how does this happen? As we had seen before, most of financial credit ratings are updated in an annual frequency, which generates gaps between the dictated assessments and the dynamic ones calculated in the specific period.
After answering the research questions, now we're able to state the research problem. So, since most of the credit ratings are updated in an annual frequency, there is no evidence of a dynamic corporate bond valuation in the Mexican financial market. This causes information asymmetry, as the dictated evaluations and the dynamic ones over a period may vary, leading to the missing of financing opportunities for companies and investors.
Having all this in mind, considering the limitation of the previously commented traditional static valuation, we will develop a dynamic estimation method carried out by a robot advisor we will create for corporate bond yields by the use of the Merton Model, identifying in an automatized way misvaluation periods for this debt security in the Mexican market, which, as we prove in our background, are really likely to be presented due to the independent impact of credit rating agencies in bond prices.
In order to reach our main objective, we must follow the next specific objectives. First, we're going to take a look at the Mexican financial market to select the representative corporate bonds for our investigation.
The second objective is to develop a method with Merton's model and the faster rate formula as a base, so we can obtain the yield spreads of corporate bonds and compare them with their actual value in the market. We decided to base our project on Merton's model due to its practicality and the fact that it includes 7 significant parameters that represent the financial health of a company.
Our third specific objective will be the creation of an algorithm in R programming language that constantly identifies inequities in the valuation of corporate bond yields given to the commented static valuation of credit rating agencies.
We will base our study on these 6 companies from different industries in order to assess if there are differences or specific behaviors according to the industry. Also, these companies represent 51% of the Mexican financial market. It is important to highlight that a project can be applied in any Mexican or foreign company, but we will base our study on the Mexican market.
Going forward, here's the literature review that we're going to follow. There are 5 examples of papers in which the authors incorporate different spreads between bond yields, as the ones we're going to be using in our research. First, we will start with the work of Ramaswamy and Sanderson, who in 1993 developed a paper in which they conducted a corporate bond valuation contemplating the magnitude of the yield spread between United States corporate and government bonds for the period between 1926 to 1986. This is a really useful framework due to the fact we're going to be using as well corporate bond yields basing on the same spread they managed to determine the differentials of.
Erickson and Renevay published The Valuation of Corporate Liabilities, Theory and Tests of 2001, where they suggest a new corporate bond valuation and a yield spread prediction using an efficient maximum likelihood methodology, which is based on their Black-Scholes and Merton Model. However, this is a static investigation made on USA corporate bonds, and our project intends to do it in a dynamic way and on Mexican corporate bonds.
In 2004, Dr. John, Helwe, and Jing set 5 structural models on corporate bond pricing, taking a sample of 182 bond prices from different firms in the United States from the periods of 1986 to 1997. They conclude that the 5 structural models, including Merton, cannot accurately price corporate bonds. In our project, we will do the same by analyzing if the predicted yield spreads can match the yield spreads from the market. The difference is that we will use only Merton model and a dynamic estimation of corporate bond pricing in order to have updated information and accurate results. Also, we will test a model for the Mexican market, which no one has ever analyzed before.
Now, in 2009, Nakashima and Saito published a paper called Credit Spreads on Corporate Bonds and the Macroeconomy in Japan. Here, the authors explored the determinants of credit spreads in Japan using corporate bonds. They find that there is a strong relation between credit spreads and the default risk of the whole company. According to the article, corporate bond pricing in the Japanese market is very consistent with the standard version of Merton. This paper gives us the basis to evaluate the strength of this relation, but for the Mexican market, in order to have certain results.
By last, in the research made by Li, Chu, and Chung in 2017, Taiwan's corporate and treasury bond market data from 1991 to 2013 was used to calculate yield spreads and bond prices. They managed to develop a feasible corporate bond valuation for an emerging market as Taiwan, in which 98% of the theoretical bond results only varied in a 5% range with the others. This paper gives us a stronger framework for the development of our research. As the authors, we are going to be developing a corporate bond valuation for an emerging country, in this case Mexico, calculating the same yield spread they did, making it a really important research in our literature review.
The epistemological position is the branch of philosophy that studies the human knowledge and its method. In our project, we're going to use the constructivism position. The reason of this selection is because this theory understands that knowledge is the result of a process of construction. And in our case, we will start by constructing an econometric model followed by a time series analysis.
Our research will be based on quantitative type due to a mathematical approach, and also hypothetical and deductive in order to infer if the predicted yield spreads are equal as the yield spreads observed in the market.
The techniques we're going to be implementing in this thesis are statistical, due to the use of the historical information basing on its behavior to conduct our study. Computational, as we're going to be using R studio programming to develop our modeling based on the statistical historical information. And bibliographic, basing on the previous work along the different papers that have been published related to our topic.
The following slides contain the bibliography we used for this presentation and the references we're going to use for the whole project. We thank you very much for your time and attention, and we hope to obtain your approval to carry out this project next semester.
Thank you.
Thank you.
Thank you.